The initial public offer of Happiest Mind Technologies Limited has opened for subscription today. In our Ideas for Profit, we'll discuss if investors should look to subscribe this stock and if this stock could make your portfolio happy. Well, the IPO couldn't have been better timed when actually we are seeing higher spending on technology and digital in particular, which is witnessing a stronger surge post-COVID-19. Now founded by Ashok Soota, who started this company back in 2011, Happiest Minds has had a rather checkered financial track record in the past, but has been showing promises in the more recent years. Now the issue size at the upper end of the price band at 165 to 166 rupees per share is at 702 crore rupees, of which the fresh issue is 110 crore rupees, with the remaining 592 crore rupees which is offer for sale from promoter Mr. Ashok Soota, who's monetizing 12% of his stake for 140 crore rupees, and the private equity fund that is CDMB2, which is advised by JP Morgan, that is exiting for 452 crore rupees right now. Now Happiest Minds positions itself as born digital, born agile company which is focusing on delivering a seamless digital experience to its customers. Now the principal offerings also include the digital transformation from the company platform, also the engineering as well as infrastructure management and the security services as well. Now close to 97% of the revenues are derived from the digital services alone. Now USA and UK are the key markets for the company, with 77.5% of the revenue coming from US and 12% coming from the UK. Now the impact of COVID-19 has been insignificant, as the company has minimum presence in the troubled verticals of, say, travel and hospitality. Now close to 42% of the revenues come from the promising areas of edutech and also high tech. And also 76% of the revenues are in the industries which have little impact of COVID-19 really. Now, however, in the remaining 24%, there could be some short-term impact which we are not ruling out. Now, the balance sheet remains quite healthy with a net debt to equity ratio of 9% as of June 2020, and the IPO funds are largely going to be used to meet all the working capital requirements for the company. Now, what do we really like most about the company is that digital is at an inflection point. Now, the global technology spend is expected to reach $6,080 billion by 2025, which is showing a growth of 6.3% really. Within that, the digital spending is expected to grow at a healthy CAGR of, say, 20.19%, almost 8.6 times the growth of the traditional IT business. So the opportunity size is huge and thereby presenting immense opportunity to digital focused services companies like Happiest Minds really going on from here. Now, the company did see some significant improvement in the operating margin in Q1 FY21, while a sharp reduction in the SG&A, which is selling, general and administrative expenses that's due to COVID-19 and work from home as well, were largely responsible for the same. Also, if you really see, the management has mentioned that the SG&A is at least 7.5 to 8% higher than the competitors, and there is headroom to bring it down by 2% annually, thereby providing a kicker for the operating margin as well. Now, the utilization level is also a modest 75% as on June 2020, which could be a lever for margin improvement as well going forward from here. Now, attrition rate that was much above the industry average at over 25% in FY19 has now come down to 18.7% at the end of FY20, and thereby indicating that the company might save on the additional cost for employee retention as well. Now, the company has a 92% repeat business and has a relatively low dependence on the top client at 12%. Now, the high share of employees working offshore is positive for margin. Now, in fact, the company reported an operating loss and net loss at late say in FY18, and that remains to be seen if the margin uptick really sustains from here on going forward also for the company. Now, Ashok Soota, who has co-founded Mindtree also before, remains the principal shareholder and the face of the company. We are still not sure about the equally competent line of succession going forward. The promoter had pledged 61% of the pre-IPO holding, which is now likely to get reversed as well. Now, the Indian IT industry is definitely faced with shortage of employees skilled in the emerging technologies per se. Now, the company would like itself to be compared to technology companies deriving entire revenue from digital content like Globant, EPAM, Endava, and compared to them, the valuation at the IPO price at least is at a discount. However, the consistent future performance would definitely be key as these peers are larger. They have shown a very high rate of growth also in the past. Now, given the attractive industry dynamics, we do expect a stellar debut of the stock at the bourses. However, the future re-rating over and above the listing gains would be contingent on the steady superior delivery of the company that it can provide. Now, it may be wise for investors to pocket the gains on the listing day and wait on the sidelines for a better re-entry opportunity thereof.